good morning. Welcome back to the broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, December 17th, 2023. We've got another great show for you this week. We've got the Legal Eagles, David Levine and Kevin Walsh of Groom Law Group, here to break down the recent fiduciary hearings. And then Oliver Renick of the Schwab Network will be here to break down the Federal Reserve rate decision and how markets responded. So sit back, relax, enjoy this episode of BRN Sunday.
I'll be here when you are ready to roll with the change.
We're going to kick off the show with a look at what is happening on Capitol Hill. Big news this week. It was a fiduciary rule hearing. Here to break down and provide analysis around that, David Levine, Kevin Walsh, both are principals with Groom Law Group. That's an employee benefits law firm based in Washington, D.C. We also affectionately call them the Legal Eagles after the Robert Redford film. At least that's from my perspective. Eagles, great to talk to you. Thanks so much for joining us on the program this morning.
Jeff, thank you so much as always for having us. Definitely an interesting week in D.C. with a virtual fiduciary rule hearing where the comment period is still going. And without further ado, I figure we should turn it over to my friend, Mr. Walsh, who was there first person testifying.
Yeah, Kevin, you teed this up very nicely last week about this precedent-setting hearing in advance of the actual formal, the comment period and all that kind of stuff. Kevin, I want to get your analysis and perspective. You were right in the throes of things per David's comment. Reaction?
I mean, I think my initial reaction is that the Labor Department did a great job at engaging with those who testified, and that, when folks testified and had, ideas that may not have been fully fleshed out, the department did a good job at, really trying to flesh them out to understand what commenters were saying. Now, that being said, if they had given commenters more time, if they had done this after the hearing period, the testimony may have been more fully fleshed out to start with. In terms of what was said in particular, it seemed like the hearing focused on, really two issues. One is what's the difference between a best interest standard and ERISA standard? And, I think that, there were a number of consumer group commenters who were essentially pushing that, we have a number of financial institutions that operate in a best interest world. So why won't they just take on ERISA fiduciary world? And so, it's a nuanced discussion. Different folks have different views. I tried to walk through the statutory differences between ERISA statute and some of these standards, but ultimately that was one of the big focal points of the discussion is what is the difference or what are the differences between the different best interest standards? You've got an insurance standard, you've got a security standard, you've got an ERISA standard, you've got a state standard. So what are some of the differences in those standards that consumer groups want to see brought over here or that, industry groups think are inappropriate in the retirement space, whether it's plan or individual? The second big issue is, really who should be a fiduciary? Like, what are the outer bounds of fiduciary status? And that comes down to what's investment advice and who's the investment advice recipient that ERISA is designed to cover. Industry groups seem to suggest, or consumer groups seem to suggest that, the purpose of ERISA is to protect retirement savings wherever it is. And that the Labor Department should have an expansive view of ERISA that, goes beyond employer plans, that really captures all rollovers, that captures, advice that someone gets when they're using money, essentially that was in the retirement system at one point.
Yeah.
David, you're coming in?
Oh, no, I made a comment. That was me ruining your flow. I'm sorry, Kevin, keep going.
Oh, no worries. So, and then industry group was pushing back saying, ERISA as a statute has its limits. And while there is some sympathy for the idea that, it's important to have strong regulatory standards for, retirement savings, wherever they may be, if they're in the retirement system or elsewhere. Congress picked a whole host of regulators to regulate it. And, there's that saying, don't take down fences if you don't know why they're put up. And that there might be some good reasons for why, insurance is regulated the way it is, why securities are regulated the way they are, why brokers and advisors are regulated differently. And that, the Labor Department stepping in as kind of a uniform regulator might not be appropriate. So, after 2 days, a lot was said, a little bit was learned. I wish we had more time to provide comments. But, I think it was a valuable experience in seeing, at least the preliminary thoughts of many groups that are very interested in the outcome of this rulemaking.
Yeah. David, I want to flip to you because I want to pull back a little bit but before I do that, I want to ask, give you an opportunity. How did Kevin do in his testimony?
Oh, first of all, Kevin was great.
Yeah.
That's an absolute given. I also know that if I say anything other than that,
You're
it's
going
kind
to
of
get it
like,
on the
you know,
back
those
end, right?
online.
Yeah.
It's like those online ratings things where they
Yeah.
keep saying, "Don't rate us unless you give 5 stars." So of course I give 5 stars, and it was truly earned.
Yeah.
But going beyond that, as you know, what I often like to do is sort of come back to, let's talk about constituencies. Where do we go from here? Because we still have the comment period through the beginning of January. Hopefully it gets extended, but as of now, the answer was no on that.
Mhm.
So you have plan sponsors. What are they to do? Some plan sponsors may want to engage, but I think the lion's share of them are sort of sitting and watching to see where this comes down. Because admittedly, plan sponsors, their full-time job usually is not being plan sponsors, it's running businesses. So a lot of them are watching trade groups and seeing what happens. Depending where it lands, there could be a lot of contractual changes, a lot of things to deal with, but not yet. It's good to be aware and watching, but not something to just jump right in necessarily. For people, I'll call it the intermediaries, the advisors, the consultants. For a number of them, this rule could have some real impacts. And as advisors and consultants have taken on more duties, I think some of these changes in here could have a direct impact on them, especially if they're doing things like managing money or providing services or recommending services in non-fiduciary ways. This could have an impact. I know we've talked to a bunch of people about that. Similarly, record keepers and TPAs, certainly their business models have evolved. They are actively involved, and I know they will through their trades and individually. Some comments through us for all these different groups will be going in. And then importantly, and definitely not last, is I'll call it the product creators. And some of the people in the other two groups before this qualify in there as well. Product creators, certainly insurance is a big area of concern given the huge changes there we've talked about before. They will be very active, as will people wanting to know sort of distribution and sales. There was a lot of discussion of that, and it's important to be wary. And then, of course, I'll add one more thing is to talk about also, as Kevin said, there's the discussion of wealth management and rollovers. That's really at the center of a lot of discussions here. Wealth management and rollover folks, advisors, and high net worth individuals, advisors, this is very relevant to you. It could impact your business models. And we talked to a lot of people about this. This is something to keep on the radar. So in short, if you want to comment, now's a good time. But if nothing else, be wary and be watching.
Last question for you, gentlemen. And I wanted to just take a step back because last week when we spoke to Kevin, I'll start with you, David. This was precedent setting in that kind of, I'm going to use my words, not using his words, putting the cart before the horse, having the hearing before that comment period. Could this be an approach used for other regulation that comes down the pike? So is this this is more of a hypothetical. Could this approach be used for other rules and regulations that are coming down the pike? If it sounds like the hearings were very successful, not ideal that the comment period didn't precede the hearing, but could that be an approach going forward based on how this all turns out?
I could definitely see this. Hey, Kevin, I got to go first on this one. You're going to let me go. Because Kevin loves regulatory stuff, and he loves this.
Yeah. We'll come back to you in a second, Kev.
No, all jokes aside, I knew Kevin would want this one. I'll go very short. First of all, there's going to probably be litigation depending where this rule lands. You know, people have been talking about that, and this could get drawn into it. So we'll see where that goes. And yes, could they try to use this approach? Absolutely. You've also seen back in the Affordable Care Act with a bunch of other legislation, interim final regulations that kind of just speed and skip through the process, and then you get regulations done afterwards. So there are a bunch of paths, but I know my friend Mr. Walsh is chomping at the bit, so I will shut up.
Kevin, David did a great job. Your thoughts?
I could see regulators using this process. Now, I think there's some big minuses to it because, the goal of this commenting process, the goal of these hearings is that folks can have a meaningful opportunity to provide, their views on the proposal. And it really puts trades in a tough spot. It puts commenters in a tough spot. The hearing was about, 40-ish days, maybe 20-ish business days after the proposal came out. And it's not just digesting it that you need to do. It's not just figuring out what you want to say. But if you're working with a trade association, you've got a number of members, and you've got to make sure that folks are on board with what you're saying. And you've got to get those constituencies. And, if you're only getting at one bite of the apple, it seems like it makes a lot more sense to, give people enough time that they can figure out what they're going to say, and then give them an opportunity to see what others are saying by their comment letters. To some extent, it's like an oral final, like a dissertation where you're defending your dissertation. And, if you haven't written your dissertation yet, it can be a lot tougher to defend it.
Yeah. Well, really good point. Excellent analysis in terms of the fiduciary rule hearings, but also, procedurally, could this be the way forward? Gentlemen, we're going to leave it there. Great to talk to you. Enjoy the rest of your weekend. We'll talk to you again both very soon.
Thanks for having us on, and thank you, listeners.
Bye, gentlemen. Bye-bye.
Bye-bye.
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Welcome back. Now time to talk about markets. A lot going on in the markets these days. Some good news, some mixed signals maybe. Join us on the line to help make sense of it and break it all down. Oliver Renick is the lead anchor for the Schwab Network. Oliver, thanks so much for popping by the program again this morning.
Sure thing, Jeff. Appreciate the invite.
All right. Well, I mean, you have it's an open, evergreen invitation. When you're available, we'd love to have you.
That.
Oliver, I want to get your reaction to the Fed chairman announcement about interest rates first, and we can kind of go from there.
Yeah. So no change to rates, which was expected, but what was not expected, including by myself, was the addition of 3 dot plot cuts for next year. So the Fed's projections going forward, we got the update for the dot plot. Some people call it the SEP, the dot plot. It's easier to think about. It's just where they think rates are going to be. And it gets you to 3 interest rate cuts next year. Going into it, my mindset was that they wouldn't add more than 2, that they would kind of signal 1 to 2 next year. The market was pricing in 4 going into the event, where the Fed's previous indications had 0, and the Fed put now 3 cuts on the, not a technical timeline, not a plan. The Fed talks down the dots. They want you to think that the dots don't matter, but it's like saying don't say Fight Club. That's where the action goes down.
I can't believe you brought that cultural reference
into
this.
I stole that from somebody.
Yeah, okay.
Yeah,
on the show?
On Twitter, put that out.
Oh, okay, that's good. Okay, well, you didn't have to tell us that, but
great.
I didn't think a Brad Pitt movie would ever make it onto the program. But anyway, go ahead. I'm sorry.
Well, I love it. That's why I'm picking up and running with it, because that's moved the market an insane amount. And well, an insane amount meaning that the market had a very powerful response to it. I don't want to say it's insane, but we saw yields plunged, dollar slid, the stock market rallied. So a lot of these things you expect, if you had known ahead of time that they were going to put 3 cuts on the dot plot, this was a pretty predictable response. But the fact that they did it was a surprise. And then on top of it, it wasn't just that there were cuts on the dots. It was that Powell just did not change anything in his language whatsoever. So there's obviously a shift happening in the mindset of the Fed members, but then the Fed chair just uses all the same language that he always has. And the most egregious example of that, I believe, is when he basically, pretty early on in his speech, said that we are monitoring for the effects of our policy, that we believe we're still restrictive, and we're waiting to watch the effects of that. This is a framework that he's using that is hugely out of date. Like, not even, it's shocking that there was no updated framework for the way he views quote-unquote restrictive conditions and why they are still looking for lagged effects, because financial conditions are the loosest they've been in a year. Mortgage rates are now below where they were in October 22. You've had a big rally in asset prices, of course. Consumer sentiment is very good. The data are strong. Jobs market has steadily softened in the past year, but we're still at 3.7% unemployment. People are coming into the workforce, and it's very healthy. We had good data this week for retail sales and jobless claims. So the point is that, oh, by the way, we also had a 5% GDP print. Everybody says just ignore that. And it seems like Powell really is. It seems like he's completely ignored all of that, which is a fine thing to do, or a thing you can do if you justify it. But there's no justification for that. If he had said, all these things have happened, asset prices have risen, stock markets rallied, financial conditions have loosened, rates have come down, affordability has gone up, and we are still signaling cuts because we are confident that inflation is going to come back down, and it was a whole supply issue, and we don't want to get in the way of this big refresh in the economy. But he didn't say that. Instead, he acts like they're looking for lagged effects, but then they're signaling cuts, so those cuts now priced into the market are going to naturally eliminate a lot of potential lagged effects if there even were any. So the fact that stocks are rallying and the yield curve has been generally stable throughout the week tells us that this is not an event that's happening because we're about to fall off some economic cliff. This is an event that's happening as the Fed is responding to the drawdown in inflation, and I think it should be viewed as a stimulative growth event, basically. But that's not really how the bond market treated it. So I think it's easier to argue stocks responded the appropriate way because it allows valuations to keep floating higher based on what bonds did, but I just don't think the bond reaction necessarily makes a lot of sense.
All right, so I want to ask you a follow-up real quick, but just to preface on the bonds in a second, but just to preface, I mean, this week was a great week for the stock market, and it feels like Powell gave them everything.
All-time highs.
Yeah, I mean, 37,000 over for the Dow, right? Which I know from talking to you, that is not the best benchmark as an index,
sure,
but I mean, that's what we
still counts.
Yeah, everyone kind of keeps score, and last time I checked, it was like 35,000. So, but you bring up, so the equity market's reacting quite favorably. Powell basically gave everything that the market wanted.
Yep.
Let's talk a little about bonds.
Oh, and then the market added on more, by the way. Sorry to jump. This is really important. I forgot. Powell gave the market everything they wanted, and then the market said, okay, well, if you're going to give us that, we're actually going to price in 5 cuts. So there are 5 cuts now priced in for next year. That's what's so crazy about it, is that the market is really kind of abusing Powell's leniency.
So is he almost going to be this is a what if, and I hate to go down this road, but is he, and maybe I'll just make this rhetorical. My question is he going to be forced into doing, so he said 3, is he going to be forced into 5, or are they going to compromise somewhere in 4? But Oliver, I just want to pivot back to the bond conversation that you brought up. Bonds. How did bonds react, and treasury yields?
Yes, it's a very important point. Yields dropped all along the curve. Bonds rallied. But the short end versus the long end actually didn't change that much, and that's really important. They obviously bought the crap out of the short term because that's going to be the Fed's main playground. So if you think the Fed's going to cut, then you start scooping up all the short bonds and pushing down the yields and all the money market funds and the CDs that people have been running to, and suddenly you're taking money out of that market, basically. But anyway, that's a thought at least. But that's what happened in the short-term reaction is push down all the short yields. And then because of that, naturally, the expected interest rate from the Fed will trickle out down the rest of the curve. That's where it gets into more of a discussion. The further you get away from the Fed's controlled part of the curve, it becomes more of a little bit of a mystery of what's driving that action. Is it growth concerns but is it just repricing the Fed rate expectations, 5-10 years out? That's definitely a part of it. But what I think was the most important information is that the spread between the 10s and the 2s did not really change at all. We're still basically at the same level we've been at for, we're off the highs of the spread, but we are still quite elevated compared to the past year between the 10s to the 2s. That spread is still quite elevated compared to all of 2023, which is an important piece of information. Because if you believe the bond market's yield curve tells us something about the economy, then it suggests the economy is in very solid shape, not nearly as worrisome as it was around regional banks or in the summer when we worried about inflation kind of coming back again or stagflation. Like yield curve tells us we're in one of the best positions we've been in for the last 18 months. So that's really the most important thing, because if that's the case, yield curve's right, then all of a sudden pushing cuts next year feels like a stimulative event, which could create some major whiplash for bonds once that becomes obvious.
So, Oliver, heading into the last week or 2 weeks of the year, and there's a Christmas holiday in between. We've got New Year's Eve. What typically would happen during this time in the market? Is it a slowdown in terms of? I'm sorry. Go ahead.
Yeah, that's the other thing. You're right. It's a slowdown. It's chill. That's the other thing is that there's not a lot of volume. There's a lot of holidays. So the fact that we're supposed to get our first cut in March, calendar is the crow flies on the calendar. I don't know. It's like 4 months, but it's really like 3. It's kind of like more just like 3 months. Like technically, it's 3.5, but it's kind of more like 3. Yeah, pretty close.
Yeah,
things are going to be so quiet during the holiday.
I feel like January 1st comes rolling around. You'll go through the Christmas holiday. We get to New Year's, and then we're going to be talking about rate hikes. That's just my lack, base fundamental thought is that now all focus is going to be when we hit January 1st. We're going to be talking about these rate cuts. And is it going to be 3? Is it going to be 4? Is it going to be 5?
Exactly. Yeah.
I guess you're going to have a lot to talk about on the network. Oliver, we're going to leave it there. Always great to talk to you. Thanks for the awesome analysis, and we look forward to having you back on the program again very soon. Enjoy the rest of your weekend, my friend.
Appreciate it very much.
Thanks. Bye-bye.
Thanks, Jeff.
And that wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line, and don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives? Check out our latest content, then visit our website. We're back again tomorrow for another edition of BRN AM. We'll have a very special guest, another important topic. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.